Nilesh Shah also joining us this morning. Let's welcome him in. Nilesh, good to have you with us as always. We also heard, some very interesting conversation at the India Economic Conclave. Talking about the way forward. I just want to, put it into perspective, though, given what we're seeing currently, just in the near term, when it comes to markets at these records, there's still a lack of confidence that we'll actually manage to see growth catch up, at least as early as next year. We heard from the IMF chief as well, whether it may be commentary that's not entirely unexpected, but not really sounding like we're going to see that revival in growth in early 2020.
So India is a story which neither disappoints an optimist nor disappoints a pessimist. If you want to talk pessimistic about India, we provide them enough reasons. If you want to talk optimistic about India, we also provide them enough reasons. Our story is glass half full or half empty. Clearly, there are certain constraints which is restricting India's growth rate, and these are easily solvable problems provided there is a will. Lots of people talk about the responsibility of the government. I want to talk about the responsibility of the citizens. We got independence with the slogan "Be Indian, Buy Indian" and Swadeshi movement. Our trade deficit with China is $58 billion last year. You add Hawala, it becomes 62. You add exports routed via Bangladesh, Vietnam, it might become 70. There is no other country where Chinese are welcome so much. Now, if as citizens we are desisting Swadeshi goods and buying Videshi goods, and then we export our manufacturing jobs to China, then can we complain about lower growth? So yes, $5 trillion GDP target is an ambitious target, but if citizens and the government, judiciary and the regulator, all of us contribute, then this is achievable. But if not, then like in the past where we have missed many goals, we'll continue to underperform our potential. We are progressing, but at a speed which is slower compared to others.
We definitely are. That's what the IMF chief has also said quite clearly, Nilesh. So, in light of that, how do you, how do you manage investments currently? Would you just stick to those handful of stocks? Do you remain bullish on the outlook for markets? Because markets have been on their own trajectory right now. Still, of course, trading at those records. Would you remain with the financials, not really go into any kind of high risk zone at the moment until we do see signs of that revival?
So undoubtedly this is a challenging time. There are super large caps, probably 15 to 20 in quantity, which are trading at 40% above their Jan 18 level. There are 50 odd large caps which are trading about 15% lower than Jan 18 levels. There is a bunch of mid caps which are trading 20% below their Jan 18 levels. And then there is a bunch of small cap which trades 40% below their Jan 18 levels. So you have a range from plus 40 to minus 40 in the market. And clearly one has to be very, very careful in selecting stocks right now, because what is looking safe is extremely expensive, and what is looking cheap is not looking safe in the near term at least. Our investment philosophy at Kotak Mutual Fund has been following. One, we are trying to invest in companies which are gaining market share in a subdued economy from unorganized sector because of either GST introduction or because of technological changes or because of variety of other factors including credit slowdown. We believe in building material space, pipes, fittings, tiles, paints. We are seeing listed large companies gathering market share from unorganized sector. The second segment where we are focused upon is financial services, and within financial services there is a wide range. So we are selectively picking up those corporate focused private sector banks where NPA cycle is turning around. We are also looking at general insurance space where penetration is low, and more importantly, private players are gaining market share from the public sector insurance companies. We are also looking at selectively retail focused banks and NBFCs where governance issue and liability franchise are very strong. The third segment where we are looking at is chemicals and specialty chemicals. India is gaining market share globally through exports, and there are some unique companies in India which are in the niche segments of chemicals and specialty chemicals. In essence, if you see, our portfolio is built more bottom up, picking up on certain trends which we believe our portfolio companies will outperform in a subdued economic phase.
So, when we just look at some of these sectors, where do you think private capex will play a role? Do you think that also has to pick up infra, some of these power companies which have really not done well for a long time? You think some of them have to pick up for a big growth or a double-digit plus growth?
So undoubtedly, your economy runs on, let's say, 4 wheels: the government expenditure, the consumption, the investments, and the exports. Now today, all 4 wheels of India are slowing down, and the biggest slowdown has occurred in investment. Investments slowdown is function of multiple things. One, the past experience has not been good with regulatory changes, with delays in execution of projects. Second, the cost of capital for setting up infrastructure project in India is exorbitantly high. There is no other part of the world where real interest rates will be 5.5% in comparable economy. You don't generate 5.5% real return in equity market in many parts of the world. How can you generate that in the debt side? Third, our execution speed is much slower compared to peers. In 1 year, China builds 300 kilometers of metro. We barely complete 25 kilometers. So with high cost of capital, longer execution, and absence of enforceability of contract, we don't think infrastructure space is something where we can go blindly top down. We would like to go into infrastructure space on a more cautious basis. We do run Kotak Infrastructure and Economic Reforms Fund. There we have focused more on investing in intermediary capital goods company rather than pure capital goods company. We are, for example, investing in bearings company rather than companies which are setting up plants for making ball bearings. Our whole focus is to go into those capital goods which are intermediate stage, which have replacement market where they can continue to earn profit, and as and when the cycle of infrastructure revives, they'll be able to benefit.
Okay, fair enough. Nilesh, in terms of a couple of the pockets where you continue to be positive, I just want to focus on the oil and gas space, because lots of activity brewing there, and Reliance, of course, I know you may not comment on specific names, but Reliance has the entire telecom angle unfolding as well as the deal with BP, and the entire space is also seeing a realignment with global parties interested, divestment on the anvil. What's your view there, and what are you keenly watching?
So we are more interested in businesses where we don't have to suffer from policy risk. It's extremely impossible to predict which way policies will shape. So for example, within oil and gas, we were more focused on the gas distribution side. That's one where there is a regulatory push in terms of clean fuel. From a cost point of view, gas is cheaper than oil. There is also little bit of moat in terms of entry barriers, because it's not easy to replicate gas distribution network. So within the oil and gas space, we were more bullish on gas than on oil. Of course, if the divestment happens in refining companies, that's a great boost to the sector. Some of these public sector companies have incredible manpower and incredible assets. They just need right environment to capitalize on those assets and manpower. And with divestment, with a public-private partnership or a pure private ownership, those companies can do wonder. But again, we'll have to wait and watch at what speed divestment happens and what are the terms of the divestment.
So, when we just look at all the things and, put it in context as far as divestment goes, do you think that will be one of the big themes to focus on even for a lot of investors?
If you see top down from a need basis, in order to balance the budget, in order to ensure that we spend our money more productively, more efficiently, divestment is the right way. The three most successful examples of companies in banking space, automobile space and metal space are Axis Bank, Maruti Suzuki and Hindustan Zinc Limited. They all started their life as a public sector undertaking. Over a period of time, they transited into public-private partnership model and managerial control shifted to professionals and the economic ownership, either fully or partially, remained with the government. And all three have created fantastic track record of growth. And I'm not recommending from a stock market point of view, I'm recommending from a business point of view. It just shows that in an area where government gives up managerial control and retains economic ownership partially, that ends up creating the most successful businesses in that area. What we did with Hindustan Zinc, Maruti and Axis, if we can replicate with all other public sector enterprises which have incredible manpower and assets, then today instead of taking money from the budget directly and indirectly, they'll start contributing to the budget. That delta will allow more revenue, more resources to the government to spend on public healthcare infrastructure and so on and so forth. So on a top-down basis, there is absolute need for divestment. But in the past, we have seen vested interest who have spoiled divestment, who have ensured that divestment doesn't happen. Now, we believe divestment in India will be 2 steps forward and 1 step backward kind of scenario. Eventually, we will definitely achieve our divestment targets, but the journey will not be smooth and that volatility will be reflected into stock market as well.
Thank you so much for taking out time for us.